Dear viewers, welcome to our channel GVS Bank Academy. Today I am going to discuss CAB Advanced Bank Management Module D as for old syllabus, Module C as for new syllabus, Credit Management, Recalled Examination Questions, exam dated 17/11/2022. Presently, we are conducting online classes for JAB May 2022 examinations, CAB June 2022 examinations. Interested members are requested to contact on this number. Technical appraisal. What is meant by technical appraisal? This is credit management question number 1. Technical appraisal of credit in the credit proposal. Technical appraisal consisting of availability of basic infrastructure for that project. Infrastructure, roads, water transport to electricity, that is there. Licensing requirements, which government, from central government or state government, licensing and registration. What type of technology, whether the available technology is suitable for today's requirement. Availability of raw material, local or nearby markets or faraway places, or import of raw material. Availability of skilled, unskilled labor in that area. Uptake of products, who are the where you will mark the final products, where it will go for marketing. Technology used in production process and in product, and whether the overall technological background is of sunrise and upcoming industries, stable industries. Sunsetting means presently the industry is not in booming sector. Not in booming sector. This is about technical appraisal. Technical appraisal. Question number 2. PCE, Partial Credit Announcement of Corporate Bonds. This is RBI Circular 2015, 2016, 2018. It was introduced partial credit announcement. What is the object of this partial credit announcement? When companies are going into corporate bonds public issue, normally the investors are not investing in that bonds because of rating of the bonds, risk associated in the bonds. That's why whenever any corporate is going for bond issue in the market, that bonds are going to be given by partial credit announcement by commercial banks. That is the issue. When a bank is giving an undertaking through partial credit announcement, automatically the rating of the bond is going to be increased, enhanced. So once the rating is increased or enhanced, investors can invest in the corporate bonds. Number 1. Number 2, indirectly, when companies are borrowing from the market, and they cannot depend exclusively on the banking industry. That is also one objective. All banks, when a company is going, corporate is going for partial credit announcement issue, all banks shall provide PCE, 50% of total issue size. All scheduled banks can provide 50% too. One bank individually, it can give PCE 20% of total issue size. And before giving partial credit enhancement commitment, the pre-enhanced rating of the company is at least BBB minus or better. So any company which is having BBB and minus, then only banks are allowed to give PCE, otherwise not. And after extension of PCE, that company is going to be rated from 2 external credit rating agencies are required towards the partial credit announcement period. 2 credit agencies, they have to give rating continuously toward the maturity period of the PCE. Banks providing PCE will not be eligible to invest in this. Once after giving PCE, that bank is not allowed to invest, to purchase in these bonds. PCE by way of not in bank guarantee. So this question they had asked, whether bank can give in the way of bank guarantee? No. Once PCE will be given, that is irrevocable, that cannot be taken back by the bank. Even at the time of project failure, project bankruptcy, the PCE amount must rank below the claims of the enhanced bondholders. The PCE must rank below the claims of the enhanced bondholders. This is about the PCE. This is also important for promotion exam. What type of accounts are not eligible for restructuring? What type of accounts are eligible, not eligible for restructuring? Loss accounts, loss, fraud accounts, willful defaulters account, not eligible. What type of accounts are eligible for restructuring? Standard, substandard, doubtful accounts are eligible. Not eligible, loss accounts, fraud accounts, willful defaulters account. Fourth one, take out financing arrangement. Take out financing arrangement. Take out financing structure is essentially a mechanism designed to enable bank to avoid asset liability mismatch. What is the main object of take out financing? To avoid ALM mismatch in the bank's balance sheet. That is first. That ALM mismatch arising because of extending of bank loans to infrastructure projects. Why infrastructure project loans are long gestation period, long moratorium period, and long repayment period. But banks are accepting deposits 2 to 3 or 4 years. To avoid that, the takeout financing arrangement norms came into picture. What is meant by takeout financing? Initially, at the time of under the arrangements, initially banks are financing to infrastructure projects 3 years, 4 years, maximum 5 years under an arrangement with any infrastructure development finance company. At the time of financing itself, they are making an arrangement with infrastructure development finance company or any other financial institution that these loans are going to be taken over by IDFC or financial institution as per agreement after 4 or 5 years. Outstanding in their books on a predetermined basis. What are the predetermined? Conditional takeout finance, unconditional takeout finance. Normally, unconditional takeout finance means irrespective of the situation of the account, that loan is going to be taken over by the IDFC or other financial. Conditional takeout finance, it means at the time of takeover, in the bank books, that account must be in standard category. That account must not be restructured. That is the conditional takeout, unconditional takeout. Main objective is ALM mismatches. LE, legal entity identifier for borrowers, for remittances also. This is a part of better monitoring, better risk management. This is a 20-digit number. Validity of this number is 1 year. This number is mandatory for RTGS, NEFT, cross-border remittances, non-individual cases of 50 crores and above. Mandatory for RTGS, NEFT, cross-border remittances in case of non-individuals, 50 crores and above. In the borrowal accounts, more than 25 crores, it is mandatory they have to obtain this number by 30th April 23. About 25 crores, 30th April 23. About 10 crores, loan up to 25 crores, they have to obtain by 30th for 2024, and 5 crores and above and up to 10 crores 30th April 2025. This is the legal entity identifier card. What purpose? Through this number, worldwide unique number. By using this number, we can view all the transactions where the party is operating, what he is doing, from where he is borrowing, in which bank he is having accounts. It is part of better risk management. This was introduced. Question number 5. 6. Very important. Financing of cost overruns for project under implementation period. Normally, in the project loans, as per the original estimate, that is not going to be, project is not going to be completed. Why? Because cost overruns. Project cost overrun. Why the overrun is taking place? Sometimes date of commencement of commercial operation as per original date, that is not taking place. That is extended by 1 year, 2 years, 3 years, maximum 4 years also. So in that case, definitely the cost of the project is going to be increased. And on account of fluctuations in the value of Indian rupee. Suppose you had borrowed the loans in foreign currencies, because of fluctuations in Indian rupee versus with foreign currencies, the repayment amount is also going to be increased. Because of these two reasons, cost overrun is going to be taken place. For that, how we are dealing? That is the bank may finance additional interest during the construction which may arise on account of delay. Whatever the interest debited during the construction period, that banks may fund additionally in completion of the project. Whatever the interest debited during the construction period, banks may fund additionally. 2. Other than interest, other cost overruns, excluding interest during construction period, maximum up to 10% of the original project cost, bank may fund additionally. Other cost overruns, including interest during the up to maximum of 10% of the bank may fund. When we can disburse? Disbursement of these funds, additional funds for cost over must start only after the promoters, sponsors bring in their share of funding to the cost. First, the borrowers, they have to infuse their equivalent share of cost overrun. Then only the banks are allowed to release the 10% of the original funds. Means first contribution from the borrowers towards the cost overrun. Remaining amount, as for this, banks are allowed to disburse. This question they are asking in promotional examination also. Purpose of credit monitoring. Very useful as of today. Ensure end use of the funds. In any borrower account, end use of funds. How we can determine end use of funds? Through statement, through unit visits, through funds flow statement, through cash flow statement, through statement of account certificate. That is. To detect any deterioration in the security charged to the bank. Whatever the charge created, any deterioration, downfall is there in the security, that also we can detect through credit monitoring. Third point, to ascertain that the business continues to run on the projected lines as per the original project report. To ascertain that the business runs on the projected lines. This is the purpose of credit monitoring. Post sanction. 8th one is credit linked notes, credit default swaps. As of today, compulsory question in almost all examinations, particularly promotional examination, JAB, CAB also this question. Credit linked notes comes under part of credit derivatives. credit derivatives, where under credit derivatives, repayment of principal is linked to the credit standing of a reference asset, underlying asset. Repayment of principal is linked to the credit standing of a reference asset or entity, underlying asset. In this, the risk seller, bank is selling the risk, means it is called protection buyer. Protection buyer, banks get risk protection by paying regular premium, regular you can say insurance premium to the risk buyer, that is called protection seller, as per the agreement, which is normally, what are the protection sellers? Mutual funds, special purpose vehicles, hedge funds, other banks also, which they can participate in the protection seller, which is normally a special purpose vehicle which issued notes linked to the underlying asset of the loan, underlying assets of the loan. This is called credit linked notes, credit derivatives. Repayment of principal is linked to the credit standing on a reference assets or underlying asset. The risk seller means bank, that is called protection buyer, gets the risk protection by paying a regular premium, insurance premium to the risk seller buyer, that is called protection seller, normally a special purpose vehicle. Ultimately, credit derivatives, credit linked notes are credit risk mitigation instruments, that is there. By taking these credit derivatives, credit linked notes, the protection buyer, they are going to reduce, eliminate credit risk by taking this notes, that is there. That may be in the advance, that may be in the investment also. Credit audit. Credit audit is an examination of credit audit. After sanctioning, credit audit is an examination of various credit functions of the bank. After sanctioning, credit audit says whether they are complied the credit sanction terms and conditions, documentation, charge creation, insurance, margin, everything comes under this. Credit audit examines, verifies compliance with extent of sanction terms and conditions. Post-sanction procedures laid down by the bank internally from time to time. This is nothing but compliance of post-sanction, sanction terms and conditions, asset creation, insurance, document, charge creation, margin infusion, all verification is called as credit audit. Credit audit plays an important role in monitoring of large, not only large advances, even in small accounts also. So, the benefit of credit audit, this normally credit audit is going to be completed 3 to 6 months from the date of sanction. Normally 3 months or 3 months. So, initially any lapses are there in the documentation, disbursement, charge creation, margin infusion, that is going to be rectified through credit audit. These are the questions which are important from JAB, CAB and also from promotion examination viewpoint. Thank you very much, viewers. Presently, our JAB May examinations, CIB June examinations, we are conducting online classes, morning and flexible times, morning and evening times. Interested members are requested to contact. Thank you very much for all.